Will rising mortgage rates cool down this white-hot Silicon Valley and Bay Area housing market, or will it weather the storm? Coming up on this Silicon Valley Snapshot. The Bay Area real estate market is on absolute fire, and if you've watched my video last week and the videos before, you'll know that this is, well, it's not front page news anymore. But this new report coming out of Housing Wire shows that we have maybe something to talk about here in the early part of 2022 and how rising mortgage rates could potentially impact not just the Silicon Valley marketplace, but the entire Bay Area and potentially even the entire country. But before we get into the data, before we get into the numbers, if you're a home buyer in today's marketplace, you're looking for a comprehensive data set to assist you with your home buying decision making, you can text the word data plus the zip code, the neighborhood, the city that you're looking in, and we'll text that information straight to your inbox. And if you're a home seller in today's marketplace and you're trying to figure out, is now the right time for me to sell? Should I wait? And when I do put my home on the market, what should I price it at? All of those things and more will be covered when you text the word data plus your property address to the number down below. By the way, if you haven't watched last week's Silicon Valley Snapshot and you have a couple minutes to spare, I highly suggest that you go ahead and watch that right here. We covered a lot of data, and a lot of that I'm going to be recalling in today's video. And if you haven't watched this one, then some of the video that I talk about today, some of the things I talk about in today's video may not make sense. So I'm going to get into the topic of today, which is rising mortgage interest rates. And from housingwire.com, which is one of the premier real estate and mortgage resources online, headline reads January 13th, 2022, mortgage rates see sizable increase. The average 30-year fixed rate mortgage increased to 3.45% during the week ending January 13th, up from 3.22% the week prior, according to the latest Freddie Mac mortgage survey. A year ago, the 30-year fixed rate mortgage averaged 2.79. Oh, let's think about that here. We're talking nearly a three-quarter point increase in mortgage rates over the last year. And it's interesting because when we watched last week's video, it hasn't seemed to do anything to the market yet. And of course, we were looking at data in December. But also, if you look at the data in January, month to date, year over year, you look at almost any county, and we're still seeing much higher demand relative to last year than we are seeing supply relative to last year, meaning both supply and demand have dropped significantly. But that's because there's no homes to sell. So demand is down because there's no homes to sell, but even more down are the number of homes for sale. And that is the actual story. And if you watched last week's video, I mentioned that if we really had to think about it, it has nothing, this marketplace has nothing to do with demand. Silicon Valley, the Bay Area, guess what? There's always going to be jobs here. Hence, there's always going to be demand. Until Google dies and tech dies and the internet dies, I think we're fine here in the Bay Area in terms of demand. And the demand has never been an issue. What the real story is in 2022 leading into Q1, Q2, Q3, Q4 isn't the fact that demand is high. It's the fact that inventory is very low. And that is irrespective of mortgage rates. From what we're seeing here in real time, the mortgage rates, they absolutely mortgage rates could have an impact on overall demand. However, if you look at the net effect on the housing market, you take away maybe 10% of the buyers. We say 10% of the buyers are eliminated. We are still in a position where it is a white hot seller's market because there is still so much more demand relative to the supply that if you were to wipe away 10% of the buyers because they can no longer afford to buy, the sellers are still in a very advantageous position. And what we need to really figure out here is how much of the marketplace, how much of the demand is eliminated by every percentage point that the mortgage rates increase. You see, here's the thing. When you increase mortgage rates by 1 point, that causes a 10% decrease in purchase power. And so that's why I said when 10% of the home buyers get eliminated, and in reality, so far we've seen about 3/4 of a point. Purchase power has only been decreased by about 7.5%. If you look at the rising tides of the Silicon Valley marketplace and the Bay Area, we're expecting to see double-digit increases in home values. And when you couple that with the decrease in purchase power, that is going to really hit buyers hard in their pocketbook. The article goes on to say that the rise in mortgage rates so far this year has not affected purchase demand, but given the fast pace of home price growth, it will likely dampen demand in the near future. This is obvious. I mean, at some point, when you rise rates by a whole point, it will dampen demand. There is no question that that will happen, but will that be enough to slow the market down given the relatively low supply, even relative to the decreased demand? Let's take one sample here from last week's video. Santa Clara County, Silicon Valley. You're looking at this graph right now. You'll see that pending sales were at 692 in December, versus active inventory was around 250. And so let's just play some simple math out here real quick for me. Well, let's just say that there's 700 homes pending and 250 homes for sale. Let's say the market, the pending sales, let's say demand drops a whole 10%. Okay? Bear with me here. So now we're looking at 620 or so homes pending versus 250 homes on sale. Is that still a white hot market? I thought so. So let's play devil's advocate again. Let's say that rates increase a whole 2 points. Well, that would mean that the market that demand could drop conceivably by about 20%. Okay. Well, then that would mean that we're at 540 or 530 or so pending sales versus 250 homes on the market. You see, any way you slice it, even if we were to eliminate 20% of the demand due to rising interest rates, we'd still be in an incredibly hot seller's market. So this article is it's accurate. Demand will be impacted in some way, shape, or form. Buyers' purchase power is going to go down. However, it's not enough to negate the low inventory levels. And so if we really want to talk about rising mortgage rates impacting demand, we need to figure out, well, what's going to turn the tide on the inventory side of things as well, so that we kind of even the playing field. So if demand goes down and inventory levels start to creep up, then we could see a recipe for the Bay Area housing market to experience a bit of a slowdown. But I still don't know how that's going to happen. And by the way, if you have any thoughts on how that's going to happen, you can go ahead and leave your comments down below. I would really love to hear what you have to say. Housing Wire goes on to say economists expect rates to increase in 2022, but will still be close to record lows. The MBA forecasts that 30-year mortgage rates will reach 4% by the end of 2022. So let's talk about that real quick. 2.79 to 4%. That's a big jump. That's 1.2%. So we could conceivably see about 10 to 15% of the demand be wiped away. 10 to 15% of the buyers being no longer able to afford what they're looking for, and therefore causing a bit of an effect where those buyers come down. And so this is what happens in these types of situations. Usually what happens is that the middle third gets impacted. You see, the $4 to $5 million home market plus, those individuals, they don't care what the rates are. Right? They're usually getting private money, all cash, or have a big daddy discount at Bank of America or one of these large lenders that will basically give them money for free in order for them to bank with them. And so the $45 million space, even in some cases 3 plus, those aren't really truly impacted in these types of markets. So what really gets squeezed by this type of situation is the middle third, because what happens is you start to have people who could afford a $3 million home. Now they can really only afford like 2.7. And so then that trickles down. But then guess what? There's still a lot of buyers in that 2.7 range. So it trickles down, it trickles down, it trickles down. So really the highest impact is kind of in that top third. So like the $2 to $3 million range is where you see the majority of that we see the majority of that impact here in the Bay Area. And of course, it's market specific. So if we're talking, San Benito County, it's, it's like the $800 to $1 million market, right? And if we're in Silicon Valley, we're in the 2 to 3 range. If we're in San Francisco, we're in the 2 to 3 range. If we're in Contra Costa, we're in like the 1.5 to 2.5 range, so on and so forth. So, but here's the thing. Let's think about this logically real fast for 1 second. Do we really think that eliminating 10 to 15% of the buyers in this marketplace right now is going to make that much of a difference? And the truth is, no. Absolutely not. Case in point, I just had a listing go pending 24 hours ago. We had 10 offers on the table. If we eliminated 2 of those offers on the table, it would have done absolutely nothing to the final sales price. We still would have gotten where we went. And so that's the truth of the matter, is that even for, this marketplace, it's too protected by the low inventory levels for the mortgage rates to have a significant impact on the overall equity and the overall momentum of the real estate market here in the Bay Area. By the way, I encourage you to go back to last week's video and do an analysis on every single marketplace here in the Bay Area, just like we did. Like, let's eliminate 10 to 15 to 20% of the pending activity. Let's eliminate 10 to 15 to 20% of the buyers due to the rising mortgage rates. And we're still in a situation where sellers are in a very, very good spot. And perhaps by the end of 2022, we'll finally see that mortgage rate increase start to catch up to the marketplace and slow it down a little bit. But by then, the damage will have already been done, because we're looking right now, you're seeing the data. And if you watch last week's video, you'll know it's not looking too good for home buyers. And so even if the market starts to slow down, not turn, but even if it starts to slow down by, say, August, September, October of this year, which is a possibility, it's already too late for a lot of home buyers here. They will have already been priced out of the homes that they were looking for to begin with, because the home that they were looking for that's $2 million is now 2.25. And that is a very real possibility over the next 9 months. So let this be a warning to you. Yes, the mortgage rates are one thing, but if you're a home buyer and you're sitting on the sidelines, there's double pressure on you now. This isn't like I'm waiting for the rates to go up so that I get a discount on the home. That's a bad strategy, because what's going to happen is you're going to pay double. You're going to pay for a more expensive home with a more expensive rate. And that just hurts to think about. This is Danny Gould, everyone, with the Selling Silicon Valley Group, and I will catch all of you in the next Silicon Valley Snapshot.